Peter Rose, Longwood Currency Trading, and I'd like to chat with you a little bit about some more thoughts on the video I did the other day and also on the blog post on It'll Come Back. Those topics, or that topic has to do with the tendency I think that we all have as to when something runs against you, you go, well, you know, I'll go to a higher time frame and look at that, and well, look, it's just touching on the reversal is just touching on a 55 SMA or something like that. So it'll come back. It'll turn around and come back. And of course, the toxic nature of that kind of thought is price doesn't come back. Well, unfortunately, it does too many times to make you think that you'll be able to work it out. And the time that it doesn't come back, it costs you 20% of your account, or maybe all of your account. I've had that happen to me before, dealing with the smaller accounts, because I just don't give a shit, because it's a mini, and what do I care if it's $300? I don't care. But if it was a 10 lot, that could cost you your house. So I think that in my analysis of that, well, it's an emotional thing, right? It'll come back. That all went back to a fear of missing out. You know, you judged the trade and you really went with it. It goes against you, and you just don't want to give it up when it goes against you. You just think it's going to come back. I expressed this issue to my friend Langers, the scruffy trader over in the UK. He has a lot more experience trading than I do. He's been doing this stuff for 20 years, and his hit rate is outstanding. You know, Langers, you don't lose. I know you don't. Anyway, I was grousing to him about it, and he said, let me look at the situation. Send the details to me. And he did a video for me. And the first thing in the video, he goes, Peter, I wouldn't have made that trade at that point. I wouldn't have made any trade at that point. What were you thinking about? Fuck, Langers. Right to the heart. Boom. My problem in a lot of cases is, even though I've been studying these markets since 2007, and I was a real estate investor for 40 years, and I'm pretty well into this stuff. I tend, because I'm a software engineer, I retired as a software engineer, I've spent my life solving complex problems, and so therefore that bleeds over into my trading. I keep talking about making the trading simple, and I have made it simple, and it is simple for me. But when I get into these emotional situations, and even though I'm disciplined emotionally, hope, fear, and greed are very powerful. They're very powerful forces. And if you don't have really hard, fast rules to counteract something like fear of missing out, a FOMO, then you might take a taste of it. And then you stay with it, and then you stay with it, and you keep rationalizing it in your own mind. And look, if I have those problems, and I've got the background that I do, then those of you who may not have that background are going to be in deep shit with this particular kind of problem, this fear of missing out, and it'll come back. Those are real things. I guess the purpose of this video is that because of some words of wisdom that Langers provided for me, this particular one, the it'll come back, is not the complex clusterfuck that fear of missing out, emotional struggle is the result of. It's an observational error. Now, we all, I think, do multiple time frame analysis. If you want to know, if you're going to be day trading like I am, you're working in the 15-minute and down time frames, right? And probably trading in the 5 minute. If you're a swing trader, you got to be up on the. I mean, you could swing over a multi-day basis on maybe the 1 or the 4 hour, but you really, the longer term trades are 4 hour and daily. And if you're really if you're an investor, you're up on the weekly. So we're not even talking about investors. We're just talking about traders, right? If you're a trader, you're not on the weekly chart, boys and girls. So we all know, regardless of where we're making our trades, that you look to the higher time frames for directional bias, for the trending bias. Now, certainly, the price trends about 30% of the time. Well, that's 30% of the time on a time frame. If you are looking at a longer term time frame, then you're going to get a longer term trend, which will go over weeks, let's say, and that'll be 30% of the months that are involved in the whole cycle to run this stuff out. So you all know that you can find trends anywhere. You can find trends down on the 5 minute chart, and those will trend for 30% of some abstract other function of time. So if I'm trading down on the 15 and below, I'm looking at the daily for the trend bias. And in my particular case, in this particular trade, I looked at the daily. The daily trend is up, so there's not a bias. I look at the 4 hour, and that supports the daily, of course, because the daily is just a collection of 4 hours. But when I come down and I look at the 15 minute, which is where I tend to get my trend bias from, because I don't plan on being in the trade for more than 2 or 3 hours. I don't plan on trading on any given day for more than 2 or 3 hours. So I have felt that pretty safe, and it's worked out really well for me, that when I'm looking at the daily chart and I see that the trend is, for example, up, and I come down and I look at the 15 minute, but that 15 minutes is dramatically down biased, then I'm safe in making my short-term scalps down on the 5 minute based on the continuation of that 15 minute trend. And I think that's really logical to be able to do. Now, someone who's trading up on the higher time frames would say, well, that's counter trend, and you don't ever do that. And my thought process, well, you wouldn't want to do it over a long period of time, but if you want to short scalp the thing, you can go down onto those lower times and counterdict what's going up on the higher time frames, because the indication, the dramatic indication is what happens on the 1 minute chart will over time become manifest on the 5 minute, the 15 minute, and the daily, right? Because that's the precursor, that 1 minute. If you're going to hit a swing point, you're going to see that 1 minute chart begin to move long before you see the swing up on the 4 hour chart, right? So the 15 minute chart that you're on, when that's counter trend to the 1 hour, as long as you're not going to be in there too long, you should be okay. And that was the thrust of my analysis of that position. And that was my mistake, is that I analyzed the position and I made it more complex than it should have been. And I lost 15% of my account, or it's still fucking open. It's 15%. And I'm going to get out of that pretty soon and just take the hit so I can continue to trade. But the reason that I made it complex is because I got mixed up in thinking that it'll come back, and I was thinking that's based on a fear of missing out, and I don't have a fear of missing out. I'm not encumbered by that in my trading. I'm not afraid of missing out. So when Langers analyzed my position, none of it was equivalent, the solution to the thing wasn't equivalent to what I thought it should be, which was this fear of missing out that was generating my inability or unwillingness to take the loss. Constantly repeating in the back of my head, it'll come back. So when Langer said that I wouldn't make this trade, and then he started talking about look at the daily chart, the trend is up. What's the matter with you? And I looked at the daily chart, said I wouldn't make that fucking trade either. But then I got to thinking about that. I am a very successful trader when I follow my rules. And down on the 15-minute, that should be valid. That 15-minute should be indicating a swing point that's going on that daily chart. Now, it might take 4 or 5 days for that thing to come over. And in fact, the chart I'm looking at, the daily levels are topping out and it's reached a high point. And that's part of the complexity of the trading that I'm trying to get the fuck away from. So I'm looking at this situation as Langers is talking to me, and I'm saying, I immediately see what I did wrong. It's not a stupid error. It was a misjudgment of the situation. The daily chart was long. It showed this long progression of daily things. So it's going up. At some point, yeah, it's going to swing and it's going to come down. Now, it might come down 300 or 400 pips, 500 pips. It might come down 2,000. I don't know. But eventually, it's going to roll over and come down. So I'm looking at the 15-minute, and that's already down. But here's what I found, and in thinking about what Langers had said, that 15-minute trend was a long period downtrend over 15 minutes. I mean, it took up a third of my screen with prices moving down on the 15-minute. And of course, the 5-minute is going down and it'll pop up and it'll go down and it'll pop up. And so I'm just trading off the 5-minute on the pops off the moving averages in harmony with the 15-minute chart. But the thing that I failed to see or recognize was because the length of the 15-minute trend was long. So at some point that 15-minute trend had to start to go back up in harmony with the daily chart. Now, if it didn't start to go up and it continued to go down, there still had to be a big reaction somewhere along there, because things just don't trend forever, right? They have reactions no matter what level you're in. That's why the Richard Dennis's trading system was based on these huge long trends, and they wouldn't get out of the trade unless it went, I think it was 4 ATR against them, what they call 4R against them. A huge drop. I mean, hundreds and hundreds and hundreds of pips before they would exit their trade. But they'd been going hundreds and hundreds and 1,000 pips or whatever following that trend. That system doesn't really work now because markets are a little bit more efficient because there's more folks involved in them that are more knowledgeable, and you got computers involved in all that stuff. You still have trends, but they're not as long as that particular one, unless you're in currencies where the economic conditions of the two countries cause that situation to continue. And that's exactly what's happening with the pair that I'm following. So you have to look at that. I should have looked at that 15-minute and remembered what was going on the daily chart and said, this thing has gone on for quite a while. It may continue to go down, in which case I'd have a valid trade entry. But it could go up. In fact, the probability of the 15-minute chart to flip around from its downward trend, this lengthy downward trend, and go into a positive trend I don't know, maybe for 100 pips or it doesn't make any difference. The fucker was going to flip around. And as that flipped around, that 5-minute chart would start to go up as well. Because it would be the 5-minute and the 1 minute that were showing that it was going to go up. But right now, the 1 minute and the 5-minute were just bouncing along on that 15 minutes. So I felt safe in trading. I didn't do a comparative analysis between the length of the 15-minute downtrend with what was really happening up on the larger time frame. Even though I had looked at the larger time frame and acknowledged that the daily chart, and as a point of fact, the entire market for this particular currency pair was in a fucking uptrend, and there wasn't going to be the probability of a retracement as opposed to it continuing to go up. And when you're looking at the daily with a 100 pip ATR, what are you going to do? You're going to fight that down on the fucking 5-minute, waiting for that to turn around, which is what I did. And so I got into an it'll come back, thinking that was a fear of missing out, but it wasn't. It was simply a mistake in not evaluating the time that that 15-minute trend had been in existence, and looking at the daily chart and saying, this fucker's going to have to turn around. The probability of that turning around and moving in harmony with the daily chart is greater than it continuing down so that I could make my, 20 or 30 pips. So that's a learning event for me, an important one, and this will obviously greatly improve my success rate in all. I got to move this because the sun is starting to get into it. So the issue is not how difficult it is to extract yourself from an emotional fear of missing out situation. I mean, that becomes a huge psychological clusterfuck of work that you need to do. You know, go see a counselor to get over that shit. But it's simple. It's as simple as going with the market momentum, as opposed to price momentum. That was my error, and that will be a rule that I can, I haven't looked at it closely enough yet to say whether this rule will replace a rule that I have. I don't have very many rules, but whether this rule will replace a rule that I have, whether it will be juxtaposed between a couple of rules, or whether it will become a corollary or part of an existing rule. But a tremendous learning event. Too bad it had to cost me a lot of money to learn that, but isn't that how we learn? I've got a pretty good win-to-loss ratio of 70% when I follow my rules, and when I get off my rules, that's what drops my win-to-loss ratio, because I'll get into these it'll come back shit things. I have this 8 pip hard stop based on the currency pair that I have, trading on a 5-minute chart with an ATR of 5. I got an 8 pip ATR, and I adjust that proportionally if the ATR were to change. But regardless of that, that stop is in close. And that, in fact, does create an emotional strain by saying, oh, man, I just ought to give it a little more breathing room. I ought to let it run. I'm so very convinced, though, that in many of the runs that I had where I was successful in trading, as soon as the trade would go against me, I would get out. Now, yes, a great percentage of the time it would get banged out at my 8 pip stop. But a lot of the times, too, the price would go in my favor when the trade would go on, and then it would start to chatter and turn around and start to come back, and boom, I'm out. And I might only get a pip, or I might do a jump ball break even. But that kept me out of trouble. It's only when I violated that and I mean, I have a system, I have a set of rules. If I follow those rules, I'll work out okay. It's when I look at saying, oh, you know what, everybody is right, maybe I should take my 8 pip stop and move it out to 20 or 30 pips. which if that gets hit, then I'm really wrong. But because I'm that short-term trader, and I'm willing to trade in and out of a position multiple times during the course of the period that I'm in there, grab a pip here, grab 2 pips here, rather than waiting for the whole thing to mature, because I'm not good enough yet. I'm not as good as Langer's is in order to look at a situation like that and say, well, this thing has the potential to go any place from level to level, which is what I do. But I'm too much of a physicist and a mathematician to look at these waves, which is what the price fluctuations create, price action creates, and say, what's the probability that between my take point and the profit target of 30 points, that I'm not going to have a 10 pip reversal somewhere in there before it gets there? So if it goes up 10 pips, I think I ought to be out, if not all of my position, then at least a majority of it. And then I get into these decision processes. So my original trading process was all in at the start and all out at the end, and that works pretty good for me. But I think that based on this new revelation here, I'm not going to be fighting a fear of missing out, because I don't have that, and I'm not correlating the it'll come back with some ephemeral or non-tactile psychological thing that, oh, it'll come back, and I'm gonna, light some incense and it'll fucking come back, because it isn't. But I was basing that on this silly fear of missing out thing that I don't have. The it'll come back is caused because I can think back on all the trades that I've had that happen to, and it's all been caused because I've been following this 15-minute trend. Oh, look at this long 15-minute trend. I can trade short instead of long, where the daily is. I can get away with that. And you can get away with that many times. But when you don't get away with it, you lose literally weeks of time that you could be trading and thousands of dollars. That's very difficult to make up. You can make a 2 or 4% loss up. Fuck, I can do that in a couple of days. But try to make a 15% loss up. In order to make that 15% loss up, I'm going to have to make up a 20 or 25% loss. I'm going to have 20 or 25% gain. That could take me 2 or 3 months. So I've lost time, and I'm aggravated. But it was blackout on me here. But I'm happy that that I found where I have a weakness in the trading process. So it isn't sufficient to read a fucking book where it says multiple time frame analysis, blah 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 blah. You can't learn this shit from a book. You have to have somebody that knows what they're doing in order to kind of help you along. When you go, oh, I did this, and these are the conditions that's happening, and the brighter person, the one with the more experience, like Langer's provided for me, he goes, well, I wouldn't have taken that trade. The trend is up. Well, no shit, the trend is up. So why did I take it? I took it because of this. See, because I have that experience in trading, as soon as he said that and I looked at the chart, I said, holy shit, of course that's why I shouldn't have taken the trade. Thanks, Langers. I owe you a cup of coffee. Talk to you. And for you folks out there, and you're reading this stuff about multiple time frame analysis and all this kind of, you can't just take it word for word and build your rules off of that. You have to build your rules off your losses. Jesse Livermore said, the only way to get an education in the market is to invest your cash. That's not in a simulated account. That's a real account, real money. So it hurts when you lose. Invest your cash. Track your results and learn from your mistakes. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.